Well, Daniel, we're just in the second week, January of the new year, and investors are, of course, expecting the earnings to start coming in. Well, earnings from big retailers started trickling in, with Tesla Christmas car sales up, while Marks & Spencer food sales missing forecast. Do these results mirror the retailers in your market region?
Well, Christmas is over, yeah, even though I still feel I need to exercise a little bit because I was just eating too much during Christmas time. And when you talk about the situation in the United Kingdom, there are really two interesting things that I would like to share. And I guess this reflects very well also those reports coming today from Tesco, Marks & Spencer, and those other big companies in the United Kingdom. People in the UK still spend lots of money when it comes to food. Tesco, the supermarket chain company, was selling 600,000 turkeys now during the Christmas season. But the United Kingdom is suffering with a very high inflation rate because of this. Sales in other sectors, for example, in the electronics sector, like DVDs also, TVs, computers, those numbers have been dropping. Tesco, a little bit disappointed at the moment. They're still number one. They had a growth of 1.9% during the Christmas sales period. Experts were actually thinking that they would reach about 3.2%. Other companies like Sainsbury and also Morrison, they were actually higher than expected. Marks & Spencer was doing pretty much okay, not higher, not lower than experts were predicting. What is, though, very interesting that I would also like to share with you, that they're a little bit blaming the bad weather in the United Kingdom before Christmas, that the Christmas season was not as strong as they were predicting. But frankly speaking, don't we always say that weather is bad in the United Kingdom?
Well, Daniel, I'll have to let you go. Now, go to the gym and burn out some of those fats you accumulated during the Christmas season. All right, enjoy the rest of the day. In the U.S., stock index futures edged slightly higher ahead of the open today as investors took note of the mixed sentiment in markets overseas. On the previous trading day, the S&P 500 and Nasdaq snapped a six-day winning streak, both closing lower, as investors fretted over the possibility of China halting its treasury bond purchases and the U.S. future involvement in NAFTA. On Thursday, markets worldwide continue to pull back somewhat from recent highs. As the bond markets continue to weigh on sentiment, investors will be looking to upcoming data releases for any clues as to how the U.S. economy is performing. First up, jobless claims are due out at 8:30 a.m. Eastern Time, along with producer price index data. The monthly Treasury statement is then expected to come out at 2 p.m. Eastern Time. On the U.S. Central Bank front, New York Fed President William Dudley is expected to appear at SIFMA's U.S. Economic Outlook. In earnings, Delta Airlines is set to report its latest financial figures. And in Asia, major indices closed lower on Thursday following the softer lead from Wall Street. Investors in the region also focused on quarterly releases as Japanese corporates kicked off earnings season. The Nikkei 225 declined 0.33%, with major exporters including automakers and technology names trading lower. Over in Seoul, the Kospi finished lower by 0.45% at 2,487.91. In Sydney, the benchmark S&P ASX 200 shed 0.48% to close at 6,067.6, with most sectors except gold producers edging lower on the day. Greater China markets clung to slight gains after trading lower in the morning. Hong Kong's Hang Seng Index hovered around the flat line, trading higher by 0.03%. The index, which had closed higher for the 12th straight day on Wednesday for its longest winning streak ever, continued to hold above the 31,000 level. Mainland markets closed in positive territory, with the Shanghai Composite edging up by 0.11% and the Shenzhen Composite advancing 0.38%. And back here in Africa, Kenya Airways expects its daily direct flights to the United States that it launched for the first time in October to boost annual revenue by 10% from 2019. The carrier, which is 7.8% owned by Air France KLM, has started taking bookings for the flights to New York that will carry 234 passengers each way on a Boeing 787 Dreamliner plane. An Angolan president, João Lourenço, has removed the son of his long-serving predecessor, José Eduardo dos Santos, as head of the country's $5 billion sovereign wealth fund, the latest in a series of moves that sidelined dos Santos' allies. Lourenço, who took office in September when dos Santos stepped down after nearly 4 decades in power, has swiftly wrested control of key areas of the state by pushing aside powerful figures associated with his predecessor. He announced on Wednesday that he was replacing the board of the fund, including its head, José Filomeno dos Santos, after an external inquiry into the fund's performance and governance. The new board chairman was named as Carlos Alberto Lopes, a former finance minister. And in Ghana, consumer price inflation was roughly flat at 11.8% in December, compared with 11.7% in November. The oil, gold and cocoa exporter is following a $918 million credit program with the International Monetary Fund that aims to restore fiscal balance and narrow inflation in 2018. The government had projected end-of-year inflation of 11.2% for 2017. Non-food inflation remained flat at 13.6% in December, while food inflation edged up to 8% from 7.9% in the previous month. And Morocco's economic growth is expected to slow to 2.8% this year, down from 4% in 2017, with a decline in agricultural production as a major contributory factor. A lack of rainfall will cause farming output to fall by 1.3% this year, after a 13.6% gain last year due to better weather conditions. According to a statement from the government, annual inflation will rise to 1.5% in 2018 from 0.2% last year. The budget deficit would fall to 3.5% in 2018 from 4% last year. We'll take a quick break, and when we come back, we'll look at the world of oil. To stay with us.